Welcome to Kaiser Watch with John Kaiser. I'm your host, Jim Goddard. John, welcome back to the show.
Jim, pleasure to be back on the show.
John, why have metal and energy prices pulled back during the past week?
Jim, I think it is because industry, the manufacturing side of the world, took a reality check after the big price gains that we saw in the past week. Because when you think about what's going on, there's a lot of bad things going to happen over the next year. First of all, we got the CPI, the Consumer Price Index, inflation figures for February last week. They came in at 7.9%, which was above 7.5%. But this was before these supply shocks caused by Russia's invasion of the Ukraine and all the sanctions imposed on Russia start to kick in. And food's going to be a big part of that because Russia and Ukraine are big suppliers of wheat and other agricultural products. And right now we're not even sure that the Ukrainians will be able to plant for this year's harvest. So there's going to be some serious food shortages down the road that are going to keep the prices high, despite the decision by the Federal Reserve in the United States to start tackling high inflation by raising interest rates. They've raised the base rate by a quarter point. It's expected that this is going to continue, but it's not really going to do anything about the problem, which originally was demand overwhelming the supply made possible in the wake of the pandemic. But then that can be solved over time. But now we have these supply shocks that are structural, that aren't just a lagging effect of the pandemic lockdown measures kicking in later this year. So we're looking at a scenario minimum of stagflation, possibly a recession in Europe, where we have persistently high inflation and interest rates keep going up, which starts to cause distress in the loan market. And of course, bondholders are going to suffer big losses as the yield goes up on bond instruments. Equities might benefit, but then if we have curtailed growth and earnings expectations, they're not going to do very well either. The next other thing that's happening right now that's going to make inflation even worse is that the COVID, which has, some say, maybe half of Hong Kong's 7.4 million population has caught it, though the official statistics are considerably less. It has now shifted into mainland China. Shenzhen has now got it. Shanghai has now got it. Foxconn suspended production at its facility that makes iPhones in Shenzhen. So this is going to be a problem that shows up down the road as China, with its zero COVID policy, goes into severe lockdown. And the market, the industrial users, they were seeing these incredible price jumps. They're looking at maybe there's going to be a slowdown in the demand for our products down the road, or it's not going to be what we expect. These prices are crazy that are wiping out our margin. So there was a general pause. But the thing that really took everybody aback was the debacle last week. Monday, the price of nickel on the LME jumped to $21. The next day, they allowed it on Tuesday to trade for almost 8 hours. It ran to what was the equivalent of $45 a pound. And then at the end of the day, they just canceled all the trades, because what had happened, we discussed this last week, the Chinese stainless steel producer, Tsingshan Holdings, it had gone short possibly as much as 300,000 tons, and apparently did that somewhere between $8 and $9 a pound price. And this company was facing major margin calls. They're the ones that kicked it up to $13 a pound in the prior week. They were the ones reaching way up to try and cover their short. This, of course, there's always other shorts in the market. So the whole system was coming unglued as not just this major stainless steel producer, which also mines nickel in Indonesia, everybody, other brokerage firms, everybody, it was turning into financial stress. So the LME has kept trading suspended. The Shanghai exchange also suspended it for a day, but they started trading, and the price of nickel has come down. It's down to about the $16, $17 a pound level. The LME allowed trading to resume on Wednesday, but they included a 5% limit, and they picked $19, which was a couple dollars above what it had been in Shanghai. So bang, it was at the limit almost immediately, so nickel didn't get to trade much. Other metals, they gave a 15% band. They're now talking about giving a broader band to nickel so that it can find the proper level. But the news coming out of Asia is that Tsingshan has done a deal with at least 2 nickel producers, which will swap them 4,000 tons of LME nickel for Tsingshan's nickel mate product. And Tsingshan, it engaged in a kind of arbitrage. It doesn't produce LME grade nickel. It produces nickel pig iron for the stainless steel industry and also nickel mate, which is a better grade. And they tanked the nickel market in March of last year when they announced that we have developed a way of making battery grade nickel sulfate from our nickel mate product. And when you look at the way nickel traded, it immediately went down. It had sort of bumped up to $9 when they had put out that announcement. Then it dropped back below $8 and sat there for a while. But it was about July of last year that nickel finally crawled back into the $8 to $9 range. And it looks like from July until maybe late January, early February, that's when Tsingshan put on this position. So they've got a deal now to wind this, and of course this position stretches all the way into the future, but the future price is also was up at $45,000 a ton, and to convert that into per pound figures, you divide it by 2,205. So it was still way up there, around $21 a pound into the future. So they don't have to deliver it all at once, but they've also done standstill agreements with some of the counterparties to agree not to force delivery or closing of these transactions. So now nickel is being slowly lowered back into the grave, but it has been spooked a lot of traders about using the LME because you had 5,000 trades representing $4 billion worth of transactions arbitrarily canceled by the LME, and so there are serious questions now about to what extent can one trust anything that goes on the LME. So all these things coming together, plus the realization that this Ukraine situation, even though there's talk, there's going to be a ceasefire of some sort, all the bombing and artillery fire will end, and things might return to normal. Russia has gone to the other side. There's not going to be any way to fix what it has been done. There will be a hostility towards Russia, suspicion about its plans, its willingness to threaten a nuclear attack in the event that the United States and NATO intervene in any way. That's not going to go away unless there's a regime change where Putin and his cronies are kicked out and a different type of government comes in. Russia's going to be on the outs. So we see these higher supply shortages persist for some time down the road. And of course, the reason Tsingshan was thrown off by its short position was it never expected that Russia would actually invade Ukraine. And now, although nickel is not on the sanction list, along with all these other critical things that metals that and energy products that Russia produces, such as palladium, it is now physically impossible for Russia to deliver these products, both because of the financial sanctions that make it difficult to pay for anything, but also because the ships are not going into the ports to pick up product and deliver it. And Tsingshan was counting on Russia's Norilsk smelted LME grade nickel to come into the system, and it had undermined sort of the whole argument about, yes, you need LME grade nickel to make nickel sulfate for the battery market, because, yeah, we're going to make it directly from nickel matte, and that's how it was caught offside by this geopolitical event. And now they're being bailed out by various groups in China and some of the nickel producers, and they haven't disclosed who they are, but it wouldn't surprise me at all if it is Russia's Norilsk that's going to send its LME nickel directly to Xinjiang and swap it for the nickel matte product that can sit there for a while until it's needed. But in terms of the metal prices keeping going, the juniors have sort of stalled and pulled back. Oh, things stopped going up. It's the same old momentum game over and over again. We don't need these really high prices. We need better prices than we had between 2015 and 2020, but we don't need super high prices because those actually undermine all these new usages coming in for materials such as nickel in the lithium ion battery, and a lot of these other products the companies just stop making money. The consumer prices end up too high, demand falls off. So seeing these prices pull back and stabilize at a level that's higher than what we had during the latter half of the past decade, that's really what the resource sector needs. And a big difference between now and the China super cycle, the majors started finally taking the China super cycle seriously in 2006, and they doubled global supply over the next decade to accommodate the rise of China as a major part of the global economy. But since then, since 2015, when the metal prices went down because they had glutted, produced too much, they have not put much into the pipeline at all. So now we have a situation where if the global economy gets past this Russia-Ukraine supply shock, gets past COVID, gets back on track, starts growing, we do not have the supply, the future metal supply in the pipeline to take care of this growing demand. And that's the sweet spot for the juniors, why we're facing a multi-year resource bull cycle. Even though there are local surges and pullbacks, the longer-term trend is that we will stay with elevated metal prices, and they will rise because this time around, the producers did not respond to anything, to expectations of a clean energy transition, and we will now see these metal prices persist. And with the geopolitical shock coming from Russia's alignment with China, China's refusal to give a thumbs down to the Ukraine invasion, and the likelihood that Russia will deal with the lingering sanctions and hostility from the democratic West by dealing primarily with China, that will start to alienate the Western nations more from China, and this push to reshore away from China productive capacity and also a lot of the raw materials that come from China and its sphere of influence. There's going to be demand for this, and in a sense, this has given the whole ESG movement a major push on the upside, and that's going to be beneficial for the juniors who are going to specialize in finding and advancing, demonstrating the feasibility of projects in jurisdictions that are within the sphere of democracies.
John, if the price of nickel pulls back to $12 a pound, what does that mean for your favorite FPX nickel?
Well, FPX Nickel charged over 90 cents last week, in the beginning of the week when nickel was going crazy, and then it was suspended. And now it's back to 70 cents. Don't quite understand what the market does not get about the value equation of FPX Nickel. The company put out a press release a couple days ago in which it provided an update on the infill drilling they did at the Baptiste zone, which is the basis for the PEA that they did in late 2020. And they used a $775 a pound nickel price, which at the time of the PEA was about 75 cents higher than what the prevailing nickel price is. Within this press release, it mentioned that when they ran the PEA model, the discounted cash flow model, at $12, they came up with a considerably better value than they had in the at the 775 price, and specifically using the 8% discount rate, the after-tax NPV came in at US $4.3 billion, and the IRR at 30.2%. Now that's $12 a pound. Nickel is still at $16, $17 a pound. And what I've done in my own DCF model, I've now extended the fantasy price all the way to $20 just to show what would happen. And I've also run it at the $16 price. And so if you use a 5% to 10% discount range, these numbers based on the PEA at $12, the stock price would be $17 to $36. If you plug in the current $16 price, it jumps to $29 to $57, and heaven forbid if $20 a pound became the new reality, we're talking at a price range of $41 to $78, with 41 representing a 10% discount rate, and $78 representing a 5% discount rate. And for a base metal project, it's going to be somewhere in between, so sort of an 8% discount rate, such as the company has used. And in a sense, what's perverse is that the FPX nickel price may have pulled back because the market's, again, looking at the insanity in the price and saying, this is all unreal. It's going to be like it was in 2007, nickel after an extended period of low warehouse stocks shot to $25 a pound. Everybody got excited about nickel projects. And then, of course, nickel crashed down to the $4 to $6 a pound range, where most of these projects that the juniors had really didn't fly. And so there's this expectation, here we go again. Except this time, as I explained in your answer to the earlier question, we're dealing with a different situation. The new nickel supply needed to take care of future demand, especially if nickel remains part of the electric vehicle battery configuration when it starts going mass market exponential in 2030. There isn't enough nickel around. So although the stock has pulled back, even if you take it back to like $9 a pound, this thing is still way in the money, because back at $7.75 a pound, it was sort of $5 with a 10% discount rate and almost $14 with a 5% discount rate. And here we have this stock. They'll have a pre-feasibility study done by sometime next year. The news that they just pulled out had some good news in it. Their current mine ore schedule has about 5 years in the beginning of high nickel grade from the Baptiste, Southeast Baptiste zone. They've now pulled some holes as infill drilling, which are confirming their model that pretty confident that they're going to be able to increase to indicated, which is required for the pre-feasibility study. But they also have got the best grades yet, which means they will likely be able to push more of the higher grade material into the front of the mining schedule. And last year they also did their first drilling on the Van project, and that has grades similar to what's in this Southeast Baptiste zone. But that project, they still have to do more drilling to demonstrate to have a first inferred resource estimate, which they might have by the end of this year. But the Baptiste zone is already advanced. It's headed into pre-feasibility study. So to see that we get this higher grade, it's more abundant than originally thought, that's very good news for those who are wondering, are we going to see delays while they hem and haw whether to develop the Van or the Baptiste zone first? And both of them are probably going to be similar size. So right now, this whole company is at the cusp of being recognized by the majors as something that they need to have a stake in. And sometime in April, they'll have another update on their metallurgical tests on making nickel sulfate from the ferronickel product. And if they continue to confirm what they're already seeing, then every major who has an interest of serving the battery-grade future nickel market, if that actually exists, they will be interested in this company. But it's still sort of trading in sort of a retail, high net worth, sophisticated investor world has not yet been discovered by the institutions. And this nickel price rise will, when it all settles down, will, I think, focus attention. Okay, so now we're no longer worried that you're using $7.75 a pound. And now we're going to argue whether it's going to be $9 a pound or $12 a pound. And hey, this worked really well at $7.75 a pound. And who thinks it's going to go back down below that except Xingshan, who just lost several $billion betting that it would?
John, why did the price of Eskay Mining drop after the junior published final drill results for its Eskay project in the Golden Triangle?
The Eskay Mining project in the Golden Triangle, the Eskay project, it is a big VMS district where we are seeing multiple potential VMS clusters in there. Most of the work this year, the 98 holes they drilled, 88 of those were in the TV Jeff area, which they drilled last year and came up with some great numbers. And that kick-started the funding cycle. They raised a lot of money. They did spend most of it last year. But what the market didn't like about this press release is that there wasn't anything special new in terms of intervals. Yes, there were additional bonanza grade intervals, but the company started sketching out the dimensions of the two zones. And this is where, if you do the numbers, and you've been dreaming about a Eskay Creek 2 discovery, a 21B zone, which was 2.5 million tons of 43 gram per ton gold and 2,208 gram per ton silver, representing 3.5 million ounces gold and 180 million ounces of silver. If this is the dream that you've been expecting, what they have delivered so far falls far, far short. For example, with the TV zone, they described it as having a strike of 225 meters by 130 meters down dip. Now, they say it's still open down dip and a long strike, but they look how many holes they drilled into this particular target. Why couldn't they have stepped out more aggressively this year to show that the tonnage footprint is bigger? If you assume a 5-meter average thickness for this and a 3.0 specific gravity, this is about a 500,000 ton body. And if you maybe thicken it to 10 meters, that's about a million tons. But then when you start plugging in the sort of grades, and the TV is more a silver-rich deposit rather than a gold-rich. It looks fancy when you convert the high silver grades into gold equivalent, but that's not what TV is. TV is maybe a silver equivalent grade you should use. So that little tonnage footprint for each gram of gold, that's about 14,000 to 28,000 ounces, and for the silver, it's about 400,000 to 800,000 ounces for each 30 grams. And, if you go 2-3 grams of gold and maybe 90 grams of silver, you end up with maybe a 3 million ounce silver deposit and maybe 100,000 ounce gold deposit. So that's not really a big deal, doesn't even come close. And the Jeff target, it's a little bigger, but whereas only 3 of the holes were duds drilled into TV, a lot more of the holes drilled into Jeff were duds. So this one has a lot more holes in it. They describe it as being 625 meters long and 190 meters down dip. But the intervals are much, much narrower. If you assume 3 million or 3 meter average thickness, then you get maybe a tonnage footprint of a million tons. And if you take 2 grams per ton gold and 30 grams per ton silver, in this one the silver is considerably lower than the gold is in relative terms. Then you're talking about 1 million ounce silver, maybe 100,000 ounce gold. So again, this is not yet world-class proportions. Another thing that disappointed me was they managed to get one hole, number 81, drilled into a SkyTem target. And these were generated by this geophysical survey that they did that highlighted a lot of conductors in the vicinity of TV and Jeff, but they only got around to drilling one of them, and they had described it as having sulfides within a stockwork type zone. It's in a higher stratigraphy, in other words, a younger horizon. It's evidence that there were multiple pulses of VMS hydrothermal activity in this area, but it delivered only what they called non-reportable anomalous gold and silver values. In other words, it's on the fringes of it. They don't yet have a new focus. They still need to sort this out and find it. And in the southeastern end, about 8 kilometers to the south, the C10 and Vermilion. The Vermilion was a brand new target, but the grades weren't particularly interesting there. But the C10 delivered a couple of short, good gold intervals. It's a new center, a VMS center that has not seen any work for a long time, but it is in a less accessible area, so they're not going to be able to get in there until later in the season, maybe August. And they did not mention anything about Scarlet Ridge. And when I talked to John Decar late last year, he was very excited about Scarlet Ridge. They did a lot of sampling in that area. The mapping and prospecting showed that this is very different from what had been filed in the assessment work in the past. So in other words, what was done in the past was superficial, didn't really recognize the potential. And I was hoping to see the sample values come out, because this is an area where there's a big gold bleg anomaly, quite substantial. It's east of the Eskay Creek area. We don't quite know which stratigraphy is quite at the surface there yet, but it could be a repeat of what's at Eskay Creek. So I'm wondering if they are still awaiting those results, and we'll have one more news release that completely wraps up the season, and it shows that this area has enormous potential as a brand new cluster where no drilling has ever been done on what they are now seeing with their SkyTem survey as significant targets. So the stock pulled back because there was nothing new. People saying, okay, the company needs to do a financing. It's July or late June before they can resume with terrible 2 to 3 month assay turnaround times. It's September before we learn anything new. And in the context of a market that doesn't know which way to go, shareholders bailed, and others who are on the sidelines are saying, well, let's get this financing done, and then we'll start accumulating it. The big scenario of like multiple VMS clusters, each one of them potentially hosting an Eskay Creek equivalent style deposit. That dream remains intact, but with 200 million shares fully diluted and a 250 stock price, that's a $500 million value. And people are looking at other juniors. They're seeing gold's going to be between $1,800 and $2,000 probably for the foreseeable future. One of the problems this market has had is accepting that $1,800 to $2,000 gold is really, really good for the juniors. And so you might also see people trading out of Eskay now to buy something else that's cheaper and buy back when the seasonal aspect is gone.
John, thank you so much for the update.
You're welcome, Jim.
We've been speaking with John Kaiser. I'm Jim Goddard. Comments made on Kaiser Watch are an expression of opinion only and should not be construed in any manner whatsoever as a recommendation to buy or sell any financial instrument at any time. Archived online at kaiserresearch.com.